Welcome again to Hidden Truths. So today we have Josh Barone, who is going to speak about the global oil situation. Hi, Josh. How's everything going?
Everything's wonderful. Happy holidays to everybody out there.
Happy holidays to everyone. The end of the year. Already another year went by. Incredible.
Yeah. Kids are getting older quickly.
Yes. And so are we, right?
Yeah.
All right. So, Josh, tell us about, first of all, I think you're going to talk about the Ukrainian war with Russia. Obviously, that has some impact on the global oil situation, on the global economy. So let's get going on that topic. I'm sure everybody's very interested in learning, in understanding your point of view, at least for sure.
Yeah, this is a giant logistics issue. Okay. Oil really hasn't been taken off the market like everybody believes. Essentially, it's just logistically changing around the world as sanctions are passed and things are going on. It's why the Ukraine-Russian war is so important in this topic. Since then, everything has changed on the oil front because essentially Russia is now, they were never really a fringe player, but they're viewed as a fringe player, although they're actually a large energy exporter. EU sanctions, and we talked about this in previous stuff, December 5th, Russian oil exported by sea is now banned in the EU. And they also set a price cap of $60 on Russian oil. It seems weird that you would ban it and then set a price cap, but this is why. When they put a price cap, Russia decided, or is in that process of deciding what they're going to do. The likelihood is they'll just shut their pipelines down to Europe. So there's piped oil, and that's not banned. But what happens is if you transship from one country to another, they're looking at the importation into Europe will still be looking at the country of origin, and you won't be allowed to pay more than $60 for that oil. And that's why the price cap is in there. So I have a wonderful chart of how much oil is actually getting into Europe, and it runs for the years. If you look at that chart, you can see how much less oil they're importing from Russia. Now, they're obviously getting oil from other places, but with these bans, it's not Russia anymore. So what has Russia done? They essentially are exporting to China and India. That causes problems logistically because for Russia, the short route, so using smaller tankers, is to Europe. So you use a lot of small tankers going back and forth to Europe. And the reason they're smaller is because the Baltics have ice problems in certain times of the year. So that smaller tankers are able to deal with the ice or fortified for ice much easier than a super. So what they've done is set up a water transfer place where the little boats are bringing oil from all the different places. They're loading it onto a big Supermax and then running the Supermax either to the UAE and then transshipping off the UAE or directly to China and India. It's interesting that they would be doing this, but if you're Russia, your main export is oil. If you're going to survive, you have to export it. Also to mention, there's a pipeline that runs directly into China now, and that was fairly new. Of note, if you're in the EU, you can't bring in Russian oil. So there's this little side note of this Italian refinery in Sicily that actually produces a lot of oil and oil refined goods for Italy. It's owned by Russia. The Italians, under their new management, their new administration, basically said, hey, we're going to take this over so it's Italian currently, and in a short period of time, we'll give it back when all this stuff clears up with Russia. So it's a cheat. And that way you can import oil into the facility because it's an Italian facility, not a Russian facility, and produce the goods for Italy. It's a bit of a side note, but it shows that they're going to cheat. Because
smart is it, actually, when you think of it?
Yeah. And also in the ban, there's this little note that if there's an emergency and it's caused undue health problems in Europe, then the ban goes away and you can import. If it gets too cold, they're going to import the Russian oil and they'll just say, my population health-wise needs this, so we're bringing the Russian oil. So from my point of view, the ban isn't, and the price caps are, I don't know, not enforceable. And as Europe gets colder, you can see they're not importing there anymore or exporting there from Russia. They're going to have problems, and because they don't have the storage capacity to get all the way through winter. So they'll have to, I don't want to say refuel, but they'll have to import something from somewhere to get through winter to fill their storage. I have another chart in here that shows essentially where Russia is transshipping to. Again, we're talking about, so what the Russians like to do is they don't want to tell you where their ships are going because they're trying to avoid international bans on these countries or getting where the G7 puts enough pressure on that country to get them to change. So their ships are going out with unknown destinations. But if you look at the tracker, Bloomberg has a ship tracker that you can look at, and you can see that they're all running through the Suez and out into South Pacific and Asia Minor and Asia Greater. What is note is that all this stuff we've done, US, EU, and everything, was designed to squeeze their revenues, right? We have another chart that shows their export receipts. Nothing's changed. They're essentially still producing as much, they're still exporting as much, and the prices, why bounce around here a little bit as there was some price spikes, but essentially they haven't been hurt. They just logistically changed who they were shipping to. Now there's a little bit of cost there, but again, nothing's really happened. So as we're talking about global oil, this is really important because when we look at prices, and there was a big price spike up to 130 earlier in the year, essentially saying that there wasn't enough oil out there, and what are we going to do? Because hey, we all need it. So what our administration did is it tapped the SPR, the Strategic Petroleum Reserve. Well, that's great. They've been drawing down. They drew down 100 million barrels since spring. And effectively, all they've really done is been able, and the correlation here is probably not that great, so I don't want anybody to make that jump, but essentially price per gallon is 30 cents higher than it was pre-war. And administration wants to take credit, but that's the SPR doing that. But correlation, in my opinion, is tough. The world is somewhat awash in oil, and that's why you saw it go from 130 to, I think, 76 this morning, because we're releasing the SPR. Russian oil is still on the market. OPEC oil is still on the market. The administration went to Venezuela, took away the bans on Venezuelan oil for 6 months. So Chevron's bringing in oil from Venezuela. In my opinion, 76, the pricing pressure downwards on WTI is correct. There's a lot of oil in the world, and the invasion of Ukraine really hasn't taken that off market. It's just changed the shipping routes. And again, as we've gone 6 months into that, the shipping routes and the logistic routes are set, and they're able to transship oil. Pricing pressure to the downside with all that. At global recession and the lack of use or need in the future of oil as we go into recession. I think recession all kind of hit this morning. We've been talking about it for a while now. The idea that we are going into some type of slowdown, we think deep, is going to really put the brakes on oil and another net negative pressure on the price. Let's talk about positive pressures to the price. The end of Chinese COVID policy, zero COVID policy ending. A lot of people think that will bring a global run in all commodities as they start manufacturing again. I wouldn't hold my breath there. The problem with that is the US is still the world's consumer, and the US credit facilities to the individual are really high. What am I saying here? Everybody's got too much credit card debt. Credit card companies are charging you 30+% on that debt. People are a little bit tapped out. One, because of inflation, and two, just trying to keep up with your neighbors is not a great thing to do. We had a lot of credit in our houses. We tried to use that. We improved our houses. People have a lot of credit debt. Not good. That'll slow it down. So that's a negative pressure against oil. The idea that COVID in China, and they're going to start manufacturing again. Yes, they'll manufacture. Will it be all encompassing in creating another really bull run in commodities? I don't think so. Not quite yet. Not until the US becomes healthy again. Other positive aspects of the pricing is OPEC plus. So OPEC it's the OPEC countries plus the new or wannabe OPEC countries that they've allowed into negotiations. I've cut 2 million barrels a day. So OPEC is slowing its output, I think wisely, because they see this global recession and lack of need. OPEC is essentially trying to control the price in a range because of the Saudi, essentially it's really controlled by Saudi Arabia, have limited capacity in terms of what they have left to sell. So they want to make sure that they get that out at high prices. Although even in the 70s, they were price fixing. So there's some question, you could question that ideology if you really wanted to. But the idea that they're slowing puts upward pressure on the price. And then add to the fact that the Biden administration has come out and said, hey, if the price gets below, and I think it's just roughly say it's $70, then we're going to start repurchasing for the SPR. And we're going to start purchasing big. In fact, we're going to change the way we allow purchases, and we're going to allow competitive fixed contracts with future delivery dates. They're trying to push the market into backwardation so they can buy oil cheaper doing this kind of thing. But in my opinion, even though they're trying to push the market into backwardation so that you get cheaper prices going forward, in reality, it puts a floor into the market at $70, and the market knows that. And anytime we get near that SPR purchase price, I think you'll see it jump back up. I guess what I'm saying, you digest all this information, and you can definitely look at the chart of how the SPR draws to see that if they start buying back to where it was, that they're a large buyer in the market, a huge buyer in the market. The question is where that oil will come from. We have plenty domestic, but they won't develop that. So that's an upward pressure. I would think there's a nice floor at 70 where it can go depending on economies and the global recession and how deep that is. I wouldn't think that if it dipped down below 70, that it would stay there very long. I think that's my overall take.
Okay. All right. So you said a few really interesting things here. So when you say it floors at 70, what does this mean for investors? Is it time to buy?
So it was trading at 76 today. I don't want to tell somebody, hey, you should go do this and listen to me, and then all these factors happen. There's risk in guessing at what the price is going to be in the future. And there's lots of variables to that. With the Biden administration, if they stay true to their word and start buying at 70, you have a huge buyer at 70. And so, yes, it tends to put a floor in around that price. Global recession will determine how high it can go from there. So whether we get out to $80, $90, $100 a barrel again is really dependent on how deep a recession we go and how much overall demand worldwide there is. I would say right now, especially with OPEC cutting, the overall demand is waning, not going up. There should be some negative bias to the price of oil. Now, for consumers, if we could actually refine product, which we can't because we haven't built a new refinery in the country since the 70s, I believe it is, 70s or 80s. And because they're pollutive and people don't want that around their houses. Plus they catch on fire every year when they go from refining gasoline to refining heating oil, or maybe it's the other way when they go from refining heating oil to gasoline. Anyway, they catch on fire. That's the point. So who wants that in your backyard? And so we don't have the refining capacity that we once did. There was some idea that, hey, you can build the refiners in Mexico with naphtha, you can then transship the oil up, but that hasn't happened. Refined product is a real problem in this country, especially diesel fuels right now. There's big diesel fuel shortage, and it's one of the reasons that goods are being propped up in terms of pricing. They're expensive to move around because there's no diesel. That's not an oil WTI problem and the ability to get crude oil. That's a refining issue, and that's another animal.
Got it. You made another comment saying when the US becomes healthy again, or when the world economy becomes healthy again, obviously people are going to have to probably make some changes to their portfolio. You mentioned certain strategies. Can you just address that quickly and give maybe an overview and how you typically react in times of recession like this?
So it's simple. In times of recession, we all look to the Fed to see what the Fed does. The Fed seems a little obtuse right now in its thinking. We've talked about their tool essentially broken, and they have to remain in the media all the time at these extreme positions so interest rates don't come down on them too fast, and so they get the desired effect. That being said, let me ask you, if you're investing in long-term in a company and the revenues are shrinking in that company, the top line's shrinking, you would assume that you would buy that at a discount. You wouldn't pay fair value or even overvalue for that. The markets are still in an overvalued position according to our thinking. So as the revenue is shrinking on that company, we would make the exact assumption that stock price would come back down to a discount to that because of that revenue shrinking, i.e., you don't want to own a company that has shrinking revenue. You're looking for growth and long-term growth of that company in terms of cash flow, these things. So when that shrinks, not a good time to own equities. That being said, shifting to bonds right now even with the Fed in its hawkish stance saying, hey, maybe another 50 basis points, 25 or 50 basis points upward momentum, the current yields in the market are actually pretty good. And it's a good idea to go there. In the next 6 months to a year, you'll be paid to have done. Making the assumption we go into recession and the Fed then eases, and we're not looking for a big eases somewhat, 1%, 1.5%, something like that. At that point, after the Fed makes its first rate cut, is when you want to typically, in historical standards, is when you go back into the equity markets, not before. So we're still in a bear market. Bear markets have these really powerful up rallies in equities, and that's what you're seeing. And then what happens is reality strikes back in that, hey, it's not rosy, and then we get this big fat drop back to the old lows and maybe even lower this time. But if the Fed doesn't react and stays obtuse for too long, we'll go into a deeper recession and these bear market moves will become a little bit greater. So not a good time to own equities. If you're betting on the future growth of a company, you're better off waiting 6 months until the Fed has that first ease and then going into that position. It's too early to go in now. And again, you're just going to see a series of bear market rallies. Now, if you're a really good trader, you can play those. I've been doing this for more than 30 years. I'm not a really good trader. I don't know how to play those. I know how to play the macroeconomics of the situation.
Okay.
So here's one. Cash is an asset class. Being in cash isn't necessarily a bad position. People think they're losing money when they're in cash because of inflation, whatnot. Sometimes being in cash is the best place to be. After today's downward rally, you can see that.
Yeah, for sure. Yeah, that's a strategy that a lot of people are probably going to adopt in those times of uncertainty. Alrighty, great.
Yeah, so hopefully that helps people, and that's what we're after. That's what we're here to try to do, uncover some hidden truths. Again, I think the hidden truth here is the idea that all that Russian oil is sitting locked up in Russia, and that's simply not true.
Interesting where, like you said, uncovering the truths, where to find accurate information and valid data. That's always a challenge. So your sources of information have to be analyzed on a regular basis to make sure you get the right information to make the right decisions.
Yep.
Great. Thank you so much. That was very powerful information today, Josh. For everyone, please subscribe to the channel, visit Hidden Truths Today. We post blogs and videos every month, at least 3 or 4 every month. You'll find really important information that can help you also make the right decision. And also schedule a time to have a free portfolio analysis. It's always interesting, even if you have already someone who's taking care of your assets. It's always interesting to have a second opinion. You don't know what you're going to find, and you may find some very important information that you probably would have never thought about. The link to schedule a time is below. So please do so, and we will see you next time. Thank you very much. Thank you again, Josh.
Thank you. Happy holidays.
Happy holidays to everyone.